Bevan, thanks for joining us today for a quick video. Just wanted to start with your FY22 result, not long been printed. Can you give us a few of the highlights from that?
Yeah, pleased with the performance in FY22. Earnings up 13% and net profit up more than 40%, and that enabled us to pay a really strong dividend, 40 cents per share, which was fully imputed. Pleased about that as well. It's the result of a lot of good work the businesses have been doing. We've got our cost base in good shape. We're delivering new solutions into the market, and what you're starting to see across the portfolio is all of those businesses improving. That was a real feature of the result as well. We'd probably describe it as a bit of a platform, Mo, where there's a lot more that we want to do on top of that. So good result, good earnings and returns to our shareholders, but probably the base for us now to be investing in some of the growth in the future. Final thing I'd highlight, really happy with some of the non-financial measures in the business. Our safety, we've got our injury frequency rate down to 3.4, and on sustainability, we're 12% reduction in our carbon against our 2018 baseline. So good mix of financial and non-financial performance in the past year.
And a pretty good outlook for next year. You're expecting even stronger results. So, plenty of positivity there from your business.
Yeah, we've said we should be lifting, or we will be lifting earnings by at least 100 million in FY23 compared to FY22. Again, that's the momentum you're seeing in the businesses. We're confident we won't be having any of those COVID lockdowns, which hit us pretty hard in FY22, about $100 million impact as well. So yeah, good base performance and a good outlook for 23.
And when most people think about Fletcher's, you think Jib, you think Placemakers, some of those big brands. Are there others in the suite that people might not automatically think that's Fletcher's owned?
Yeah, we've got about 25 businesses in the portfolio across products, distribution, residential housing and construction. So a few examples. We operate in the concrete value chain in New Zealand, so you'll see Firth concrete trucks around. You've got your Golden Bay cement, Winstone aggregates. Got a big suite of steel businesses, Pacific Coil Coaters, Easy Steel. And in construction, Higgins is in they do road maintenance and paving. And in Fletcher Living, we're actually launching a new brand called Vivid Living, which is a retirement offer into our communities, which we're very excited about as well. What we like about the portfolio is those positions are all very complementary. They need to perform and stand on their own 2 feet, but they also work together to create new solutions into the market. So a really good, strong suite of businesses.
And you probably want to forget about this and put it in the rearview mirror, but COVID obviously was a reasonable impact. Can you give us an idea of what magnitude that was on your business, and are you out the other side of it now?
Yeah, first thing I'd say is really proud of how our people worked through that period. We've got about 15,000 people in New Zealand and Australia. They really had to scramble hard, to keep our operations running where we could, and also serving our customers, of course. That impact in FY22 is about $100 million to our bottom line, and that's mainly in New Zealand because we had to shut most of our operations through August and September last year. As we look ahead, we think we're out of that now. We can get on with delivering that performance that we just talked about. And importantly, it gives us what I'd call the oxygen in the business now to really focus on those growth and innovation and sustainability initiatives. So it's a bit of a financial boost not having that impact. It's also giving us the space to push on with our strategy.
And you obviously sell a lot of great building products, but you're a big builder in your own right as well, aren't you? So you think about the housing market, it's topical at the moment. How do you manage the ups and downs and the risks that come with big price movements like we're seeing at the moment in the housing market?
Yeah, look, it's challenging. It's been a challenge in our businesses and also in our customers' businesses. What I'd say is that in Fletcher Living, we take a very long-term perspective. We build communities at scale. We do it efficiently. But what's important for us is creating the amenity in those communities which create great long-term development. So we set some pretty clear financial guardrails there. We need margins of 15 to 20% and we need returns above 15%. So where we can't do that, we don't play. And what adds value into our communities and delivers those levels of return is the fact that we're taking a community build approach to housing.
And every business I talk to is talking about cost pressures, whether it's materials, whether it's supply chain, labour. How's Fletcher's managing that? And is there things you can do around innovation, new products, new ways of production, I guess, to try and take some of those cost pressures away?
Yeah, look, it's been you're right, Mo, a big theme of the last 12, 18 months. We expect it to continue to be like that probably for the next 12 months or so. Pressure on labour, logistics, they're still there. The first thing is you need to be fighting fit. You've got to get your overall cost base in the right shape, and that's a lot of the work we did through 2018 to 2020. So we got efficient. And then when you're pushing those revenue growth initiatives, you've got a good base that you can leverage across. So we'll continue to invest in automation in our manufacturing base. We'll get more efficient through digital as well. So we've now got almost 200,000 customers online and online revenue of about half a billion. So you've got to be fit, and then you can build these initiatives which create the efficiencies on top of that.
And for our investors, sustainability is becoming a key pillar of their sort of process of selecting stocks. So have you got some targets in place around sustainability, and have you got some examples you can give us of things you're doing around sustainability in your business? Yeah,
it's massively important for us and for our customers and our people as well. So what are our targets? We've got a target to reduce our carbon emissions by 30% at least by 2030, and we're already 12% lower, so we're well on the way there. We've also got other targets around reducing the waste in our business. So we now divert more than 50% of our own waste from landfill. And then we're pushing really heavily into what most people would call the circular economy. So recycling and reuse. A great example there in our Golden Bay cement business near Whangarei. We're now using around 3 million waste tyres a year, replacing coal. It's because the kiln is so hot, you can combust those tyres with low emissions and substitute the coal that you would otherwise be using. So we're more than 50% replacement of coal in that business as well. And good environmental outcome, no tyres into landfill, lower carbon reductions. There's also an economic benefit. If you think what's happened to the price of coal in the last 12 months, it's bringing financial and sustainability outcomes together.
Thank you. And I guess to finish, there'll be people watching this video that are looking to dip their toe into the investment game.
Yeah.
Have you got any advice, or can you tell us about your first investment experience to give people a little bit of insight into that?
Yeah, well, I grew up on a farm in Northland in Waipu, so my first investment was into a calf. Actually, Dad said, there's a calf, you can buy that if you want, so I don't know what it costs, it's probably $50 or $60, and did well out of it, 4 years later. So that was my first investment. I guess what's my own personal approach? I tend to look for really good long-term businesses. I sometimes feel the markets can get quite short-term focused, but I look for businesses and opportunities which have really good competitive positions, really strong balance sheets, so they're going to be strong through economic cycles, and that can deliver returns over the long term, probably even longer than the calf, I would say, that I owned back then.
Yeah, it might be easier to go listed markets rather than kicking the tyres on a calf here and there. So.
Yeah.
Look, I appreciate your time, Bevan. Thanks very much for joining us.
Pleasure.